South Africa remains in recession. Stats SA reported today that gross domestic product contracted by 2% in the first quarter. The market had expected a worse outcome, but at the end of the day, a recession is the order of the day. And we know that come the second quarter, the picture is going to be far worse as the economy almost came to a halt as government issued regulations to aid the country to curb the spread of coronavirus. Well, to take us through the data and provide his analysis on things, I'm joined on the line by Maarten Ackerman. He's Chief Economist and Advisory Partner at Citadel. Thanks very much, Maarten, for joining us. So a 2% contraction in the first quarter, pardon me, almost seems like a moot point because we know that the worst has yet to come. But what were your observations about the drivers of the stagnant growth even before COVID hit?
Yes, good evening. It's, we know that the economy is basically on its knees. We're sad to see another negative quarter after two negative quarters already. So it just shows you that pre-COVID, we were already in a no-growth recessionary kind of environment. Unfortunately, now with COVID as well, the second quarter is going to look much worse. But we need to remember that in the first quarter, a couple of things added to this negative number, and that's the fact that we had a lot of blackouts again, which had an impact on mining.
Yes.
And mining dropped about 21%. And although we haven't had our lockdown yet, the first quarter, China was basically closed for business, and they had a 7% decline in their GDP. So they're one of our biggest trading partners. And you can see that impact on something like mining. So, the fact that it's better than expected doesn't really help because we stay in a very deep recession. And the pain is still in the pipeline, the real pain in terms of the second quarter number that we're looking for.
It is interesting to see that the service sector or the tertiary sector was an area that remained resilient during Q1 when you look at, compared to mining and manufacturing and so on. But with the coronavirus now at our doorstep, it doesn't look like the service sector is going to be able to remain resilient.
Well, the service sector, it's been contributing positively for most quarters. We tend to be a service-based economy. However, you would really like to see the other sectors start to contribute more because that's the sector that's more job intense and where we can actually create more jobs. So you're 100% right that the positive contribution is likely to fade also going into the second quarter. Because a lot of those tertiary sector, excluding the essential services, were actually locked down for 3, 4, 5 weeks. So the positive contribution that we typically get from that sector is also likely to fade in the second quarter.
Yeah. We know that the GDP data doesn't just look at, whether the economy grew or contracted. It also looks at other data. What did we see in the area of spending in terms of the household and particularly government?
Yeah, they were basically, government spending was still the biggest contributor. Which is unfortunate because we do know that if we think about last week's budget, this is the one area where we need to cut back. Yet, although we had a positive, that's where we need to see, government pulling back. The driver behind the government expenditure going up was also more employment, and that again just doesn't dovetail with the message that we're getting from the budget. Consumer spending were soft; it was about 0.7. And at least there we can take some lead in terms of next quarter. So to give an example, the second biggest positive contributor from the consumer side was spending on alcohol and tobacco, about up 3.2% for a quarter. Now you can just imagine for the second quarter, we know that specific component's been totally removed, so there's been no activity.
Yes.
So it just shows you how the impact is also going to be felt from the consumer side going into the second quarter.
Yeah.
And then probably the biggest shocker on that front was the 21% decline in gross fixed capital formation. That's typically a leading indicator to show us that the business are confident to actually spend in the economy, reinvesting back into business and the economy. That number has been, quite weak for a number of quarters. Last year, fortunately, we've seen two quite strong quarters, and we were hoping that that's a change in trend after the investment summit that the president had.
Yes.
Now, minus 21% is in line with the weakest number we've seen since the 1960s, and that was about a 27% decline in 2008.
Yeah.
Now, again, we know that the second quarter is going to be the eye of the storm. So we expect this number to probably record its weakest print going into the next quarter. So that's unfortunately shows that business is not just worried about the local policy reform and structural changes. They're also now worried about whether they should invest given the COVID overhang.
Yeah. One last thing, you did touch on the supplementary budget delivered by the finance minister. What do we need to do to get out of the mire that we're in?
Well, I think the minister fully understands the problem and knows exactly what to do. And that was very clear from his, talking the talk. But it is exactly like we had in October. So it's one thing saying the right things with the right economic plan. If we don't see any execution in the months to come, it's not going to help us. So what we need to do is simply execute on his plan. It is the right plan. And he needs all the support that he can get from within the government and the ruling party to actually just execute on that. That will definitely get us onto a more sustainable growth path.
Thank you so much, Maarten, for your time. That was Maarten Ackerman. He's the Chief Economist at Citadel.